Hi, and welcome back again. This is Tim Biggam from Delta Derivatives, and this is Vol 411 on a very interesting day again in the volatility world. We saw the VIX briefly this morning dip below that 17 level for the first time since late February of last year, right when the COVID crisis started to really pick up in earnest here. Right now, back above 17, but we're certainly firmly, it seems like, back in that old regime of volatility bounded by 19 to the upside, 15 to the downside. So option markets and stock markets saying everything kind of back to normal. We shall see on the COVID front. Put call ratio yesterday kind of mixed here at 0.91, so right in the middle of the range. Notably, we saw 80,000 of the April traditional 18 puts trade on the call side. The usual suspects, the out of the money Aprils and Mays, as I think a lot of rolling going on out there by the big institutions as they're moving their long upside VIX protection from April to May at the cheapest level we've seen in a very long time. We see that contango really starting to steepen, especially on the short end of the curve here. As a note, the SPX straddles that I like to look at going back a month, the at-the-money straddle was trading at about a 12.5 volatility with 7 days to go, so a shorter-term straddle. It was priced right at about the 56 level. Today, with the SPX 100 and some points higher, that same straddle 7 days, right, is actually cheaper as implied volatility has moved from over 12.5, as we talked about slightly a month ago, to now under 11.5. So we've seen the SPX head higher, but the straddle actually get cheaper. Why? Because implied vol has been hit hard, especially on the short end. So we're seeing some absolute, put protection being put in place too here by institutions, because that skew is really hanging in there only at 140. So until next time, as always, this is Tim Biggam. This is Vol 411, and here's the good trading. Take care.